before the break, you heard from the author of Vanity Fair's bombshell expose questioning the timing of some big money trades in the futures markets. Many of those trades were executed ahead of market-moving comments from President Trump. Our next guest was plugged in, listened to the entire conversation. He's got a lot to say. Let's bring in Jacob Frenkel, partner at Dickinson Wright and former senior enforcement lawyer for the SEC. Jacob also worked as a U.S. federal criminal prosecutor of corruption and financial crimes. Bill Cohan is also still with us, just to add to the mix here. Jacob, do you think these trades should be investigated? Is there enough to go on?
Yes, there is enough to investigate. And I think the only thing that really was misleading here was the headline itself. I think the way Bill summarized his story really was accurate, and that is that, is that for there to be an insider trading investigation, there's usually anomalous trading in advance of an announcement. That announcement causes there to be a sudden price movement either up or down, and often, particularly in the equities markets, the regulators tend to find that there may have been people who actually were in possession of material non-public information and traded on that. And the anomalous trading is the reason that you investigate. That is the obligation of the investigator. As Bill said in his segment a few minutes ago, he wasn't saying that there was a violation, that there are grounds to investigate. I would agree with that. And to me, it's not just the regulators who should investigate. The other proper party to investigate are the firms to which these traders worked. Because in that unlikely event that there actually was a problem here, one of the things that's always stress tested is a firm's compliance system. And so there should be, at least on some level, a mini internal investigation of each of these firms to determine whether there was anything anomalous that gave rise to these trades.
The bar in terms of opening an investigation and the bar of actually finding wrongdoing, they're completely different, though, Jacob, I would assume. I would assume that the bar to prove that something was actually, a crime was committed, is much more difficult than simply opening the investigation. So what's your take on, based on the information that we have now, how a case would unfold?
Well, most of the time, you actually have investigations that open based on some generalized information that in and of itself may not be the foundation or may not be sufficient to establish a violation. Obviously, with whistleblower programs, regulators are getting access to much more and better quality information that often lets them be further along in that investigative process. But to get to the end game, if we're talking about a civil case, you still need to prove recklessness. You still need to prove some element of intent. We're not talking about equities here. I mean, a lot of trading on the, when we're talking about futures trading, the classical theories of insider trading that apply in the equities markets do not apply. It's really more of the misappropriation theory, that somebody had a duty, there was a breach of that duty, the person who traded knew about the duty and basically inherited the duty to keep information confidential and then traded. I think the bar here to bring even a civil case is very high, but again, a lot of investigations open, they're pursued, and then closed. I think that's ultimately what happens here if there is an investigation by the regulators.
So I'm sorry, Jacob, but let me just get this straight. This sort of investigation, a case would be built. It wouldn't be an insider trading case, so there wouldn't necessarily have to be an insider involved in terms of disseminating the information to the trader or the group of traders.
In the classical sense that we think about using the Whole Foods example with Amazon, that Bill used before, that scenario would not apply in the futures markets. But the misappropriation theory, the fundamental concept here is, was there fraud in connection with the trading? That's probably the most simplistic way to look at it. That's really how the CFTC is approaching its cases. Post Dodd-Frank, it established an insider trading rule. But again, that talked about fraud and deception. It wasn't really the classical insider trading as we look at on the equity side. So yes, it is not the classic corporate insider, but if we look at cases that involve political insiders, obviously if for some reason in the course of an investigation that someone was able to find that an advisor to a senior government official who knew that these announcements were going to be made and that person picked up the phone and called somebody, and that person knew about the duty, yeah, that's a game changer. But it's unlikely that that's what we're going to find, but that's really what would need to be found for there to actually be a case.
Bill, it sounds like if they were really able to make that link, that would be a whole other story for you.
It would be. That would be a blockbuster. That would get people on the street talking. Look, I appreciate what Jacob said very much. And I've always frankly wondered, you know, I know the insider trading laws apply to the equity markets, but obviously, as we've seen, there's a ton of money that could be made on whatever it is, misappropriating money in the futures market. Same with the bond market. The bond market is what, 4 times the size of the stock market, right? We know that there's a lot of information conveyed in the bond market, and for some reason that's outside insider trading laws too. I've never understood why insider trading laws, such as they are, exist only to in the equities market. They should apply, obviously, to the bond market and the futures market, because information is valuable and is obviously key to making huge amounts of money or losing money.
Jacob, last word, and I'll put that question directly to you. Do you think those insider trading laws should apply to the other markets out there, aside from the equities markets?
Well, the answer is they actually do apply, and the CFTC in 2015 brought its first insider trading case involving an oil trader, brought another one in 2016. I think the CFTC clearly is looking to expand that into tipper-tippy liability, but it's really more about the theory of the fraud, the theory of the insider trading that is different when we're talking about the futures markets. And I think there is a framework that does apply, but I think you have to look at the fundamental nature of both markets, equities versus futures, and really identify and accept how they differ fundamentally, and that's what establishes the basis for determining whether you would or would not have insider trading. But here, ultimately, I think the only thing that was really misleading was the headline, to sort of create the firestorm. I don't think this actually rises to a level where we're going to find a breach of a duty under the misappropriation theory that will result in a case.